Hi, my name is Darren Dansereau. I'm the CEO of QV Investors. I started at QV in January of 2006 and became the CEO in September of 2022. When our firm was founded back in 1996, we went by QVGD Investors. That name stood for quality, value, growth, and diversification, the characteristics we aim for in every strategy we manage. Our founder, Lee Pullen, believed it was important to have the characteristics we desire on the door as an everyday reminder of what guides our investment process. But let's be honest, QVGD was a bit of a mouthful, and we found that people were getting the order of our name mixed up, including some of our long-standing clients. So, in 2007, when we moved to new offices, we took the opportunity to simplify our name to QV Investors, focusing on the quality and the value aspects of our investment philosophy. That change didn't mean we stopped focusing on growth and diversification. We believe a high-quality portfolio would naturally include growing businesses and be thoughtfully diversified. For us, when we talk about value, we mean that we're trying to construct portfolios that on average have a lower valuation than the market. But valuation alone isn't enough, and that's where quality comes in. We focus on companies that have strong fundamentals, consistent profitability, solid balance sheets, and manageable levels of debt. We want the overall profitability of the portfolio to be higher than average and with less financial risk. This combination has helped our portfolios perform well in market growth environments. But just as important, we want to ensure companies have a margin of safety, which should allow them to do better than the average business when the market eventually has a negative return period. Ultimately, we are looking to invest in strong businesses at reasonable prices. There are a few things we would highlight that differentiates QV from other wealth management firms. At QV, we're an independent and employee-owned firm. That means no outside shareholders and no outside direction from third parties. Share ownership is purchased and has been offered to all roles within the company. We think employee ownership ensures that all of us are aligned with the strategy and success of our investment management business. We believe in aligning with our clients. Our team doesn't invest in individual stocks or bonds elsewhere. We invest in the same pooled funds we offer our clients. Simply put, we're in it with you. Another differentiator is that we have a focus on the long term. This is not only in how we invest our clients' money, but in also how we manage the firm. One of our top priorities is to continue to have strong performance by staying true to our investment philosophy and process. We're not chasing asset growth, but we believe if we stay disciplined, manage risk responsibly, and provide great personalized service to our clients, that this will lead to long-term success and asset growth over time. And lastly, we stay in touch. We've been writing and publishing market insights for over 25 years. This gives our clients some perspective into how we're thinking about the markets, what we're seeing, and how we're positioning our portfolios. We believe this additional information enhances our clients' understanding of our investment strategy and helps provide updates in between quarterly reports and meetings. In the investment industry, risk management can mean a lot of different things. Some view it as more statistical, using terms such as tracking error or value at risk, but we try to keep it simple. For us, it's defined as the potential loss of capital. We're trying to avoid a large permanent loss because, as you know, if you experience a loss in your assets, it takes a higher return to get back to the original investment amount. For example, if you lose 50% of your original investment, then you need 100% return just to get back to that same level you started with. We know we can't control markets, but we can control what our portfolios look like. That's where our portfolio risk management process comes in. Each month, our risk analyst prepares a comprehensive report for every strategy we manage. This proprietary document tracks over 25 different characteristics, both at the overall portfolio and individual company level. It allows us to assess not just where the portfolio stands today, but how it's evolved over time and how it compares to its relevant benchmark. These reports are reviewed monthly by QV's investment committee. Portfolio managers walk through any recent changes, the rationale behind those decisions, and what adjustments may be under consideration, whether it's adding a new company, removing one, or adjusting the weights of current holdings within the portfolio. Let's walk through two examples from our risk management document. The chart on the left shows the price-earnings ratio, which is a measure of value. As we mentioned earlier, we desire a valuation level that's lower than the average of the market. In this example, you'll see the QV Canadian Equity Fund is the green line compared to the yellow line of the TSX Composite. The fund currently has a clear valuation advantage, and you can also see that this advantage has been consistent over time. The chart on the right-hand side shows the 4-year average return on equity, a measure of profitability. Once again, QV's Canadian Equity Fund is in green and the index is in yellow. What stands out here is that in the last several years, there's been a higher spread between the profitability of the companies we own versus the companies in the index. These are just two of the many characteristics we monitor across all strategies to ensure we're staying disciplined and aligned with our investment philosophy and process. We also manage risk by setting clear investment policy guidelines. In our equity portfolios, no single security can represent more than 6% of the portfolio. This prevents us from becoming too concentrated in any one business, which can be risky if something unexpected occurs. We also limit exposure to any of the 11 industry sectors to a maximum of 25%. That's because sometimes an entire sector can be negatively impacted by one factor. For example, when interest rates rise, utility stocks often decline since higher interest rates become more attractive to investors and they sell utility companies to buy GICs or bonds. Therefore, we think having more than 1/4 of the portfolio in one sector can present outsized risk, which we want to avoid. Within the TSX Composite Index, the financial sector is over 25%. Because of our sector limits, our Canadian large cap portfolio has remained below that threshold. At times, this has meant trailing the benchmark return when financials perform strongly. In other periods, it's added value. But overall, this hasn't negatively impacted our long-term performance. However, it does ensure that our downside protection is still in focus when we're managing our funds. We hope this video has helped you get a better sense of how we approach investing at QV through a disciplined process, a focus on long-term value, and a commitment to putting clients first. Since our founding nearly 30 years ago, the principles of quality and value have guided everything we do. While markets change, our philosophy has not. We continue to apply our consistent, downside-aware investment philosophy to help our clients preserve and grow their wealth. Thank you for taking the time to learn more about QV. We look forward to continuing the conversation.